I am in a good mood today. And do you know why I'm in a good mood? Because today we are going to rant about something positive. Hello, everybody. My name is Stephen Meade with Domicile Real Estate. This is Real Talk, basically, where I just rant about something that I think people should be talking about, but they are not talking about. I run a real estate brokerage here in Southern California called Domicile Real estate for people who love houses. And we are on a mission to help California's renters become homeowners. So if that is you, a renter who would like to become a homeowner, definitely reach out to us here in Southern California. All right, here's the rant. So this has been a problem for nearly 20 years. And this is the problem, is what I'm going to call the credit score game. And the credit score game, if you are already a homeowner, you know how the credit score game works. Basically, you need to get credit in order to show that you have credit and get better credit. So what do I mean by this? If you are somebody who pays for everything in cash, you save your money, you do all that, you will have a lousy credit score and you will not qualify for a mortgage. It's unfair, it's not right, but it is the way it has been for nearly 20 years. And a big reason for this is not that we don't have tools to solve this problem. In fact, we've had tools to solve this problem for a while, but Fannie Mae and Freddie Mac and basically every other mortgage lender that goes along with them has been using a very outdated version of the FICO score for credit scoring requirements. In fact, the version that most lenders use for their permanent credit scores dates back to 2004. So nearly 20 years of using what they call FICO Classic as a credit score method. And the problem with the FICO Classic credit score is actually it has two very big problems. Problem number one with the FICO Classic credit score is that it only uses debt. So other things, for example, there are other ways for you to demonstrate good payment abilities. Paying rent on time, paying your utilities on time, paying your cell phone bill on time. All of these things show good financial habits, and the FICO Classic score does not use any of that information in its scoring. So especially for younger home buyers, for first-time home buyers, this has been a huge problem. You essentially have to go out and get a bunch of credit cards and a car loan to show that you are a good credit risk, to get a good credit score, so that you can then get a loan, especially if you are looking for a low down payment loan that includes mortgage insurance. So that's been problem number one. Problem number two with the current credit scoring models is that they are like a snapshot in time, right? So if you, for example, every Christmas, or if you are the kind of person who, for example, you charge a bunch of things on a credit card and then you get an expense payoff from your company that you work for, expense reimbursement, and then those balances come down the next month. If that's you, on the day that your balance is high, you will have a lousy credit score. And the day and after you pay it off, your credit score will go back up. It's kind of this weird cycle. Now, you as a credit risk did not change significantly during that time period, right? Like you're not a different person. You're the same person. And yet your credit score could have moved 80 points based on that. So what has been missing has been trend data, right? Like looking at not just where are you this second in time, but looking at trends. For example, do you charge a bunch and pay it down the next month? That's a trend, right? Do you have a situation where you go into debt towards the end of the year and then you pay it off at the beginning of the year, every year like clockwork? These are all trends, right? And the current scoring models do not use any trending data, which I think, for some people, right, that lets them keep a high credit score. And honestly, they probably shouldn't have a high credit score. And for other people, it really has penalized them not having that data in there because of certain things about their spending habits. They're good credit risks, but they look bad on paper depending on what day of the month you were to go ahead and look at their data. So this week, in fact, or maybe a little bit about a week ago, basically the federal government has authorized 2 new credit scores to be used for borrowers. And they haven't said exactly when these are going to be implemented. I hope it's soon. But they are implementing something called FICO 10T, and that is the latest version of the FICO score. And the T stands for trending, meaning it uses kind of this looking over a period of time sort of approach to your financial habits. And they've incorporated something called Vantage Score 4.0. Vantage Score is an alternative to the FICO score. It's actually jointly owned by the three credit bureaus who put this together. They were the first ones to start using this sort of alternative credit data, like paying your cell phone bill, paying your utilities, paying your rent. And, here's the great news for this, right? The reason why this is something good and something I'm excited about is, number one, it's more fair. So this is a more accurate view. The whole point of a credit score, the purpose, its reason for existing, is to predict which people are going to default and which people are not, and to make credit decisions. So the more accurate that model is, the fairer it is. So number one, this is a more fair model. Number two, there are large swaths of the population that have traditionally not been big credit users. These are typically minorities, right? Where culturally, there has not been a big history of credit card, car loans. A lot of things were paid in cash. These people could be excellent credit risks, meaning they could be perfect and ready for homeownership, but they have either a low credit score because of a lack of traditional credit history, or no score at all. In both of those situations, make it very difficult to get a mortgage. So this opens up the opportunity to buy a home to a lot of people really that had previously been excluded by it. And I think that's something that's really exciting to me. So the only question is, how fast is it going to be to implement this? Basically, they have said at Fannie Mae and Freddie Mac that this will be a multi-year implementation strategy. It'll probably come in phases. I'm really hoping that FICO 10 phase comes in soon, though, because that alternative credit data, I really think is going to be a huge benefit to a lot of first-time home buyers out there. And we are really entering into a market where we are seeing more first-time home buyers. It really is a market that I think is a very good opportunity for first-time home buyers. They are not competing against move-up buyers right now because of interest rates. So definitely something we are excited about. This is a good news rant. The mortgage qualifying and credit qualifying is about to have a huge revolution. This is the biggest change in probably 20 years for mortgage qualification, and it's something we're excited about. If you are looking to buy or sell residential real estate here in Southern California, namely Orange and Los Angeles counties, absolutely reach out to us. We would love to lend you our expertise. Questions and comments, as always, we love them. Do not forget to like, subscribe, and hit that notification bell, and we will see you again real soon.